Hello, and welcome to Quantum Advisory's investment vodcast for Q2 of 2022. In this presentation, we'll cover a brief market summary, look at economic developments over the quarter, and from there we'll discuss the outlook and consider some of the possible short and medium-term outcomes. Firstly, a quick summary of the market over the second quarter of 2022. As this slide shows, the second quarter of 2022 saw a continuation of the prevailing trends with another period of negative returns. Inflation pressure caused by supply shocks continued to dominate as fears over an inflationary recession became more prominent. These fears fed through to consumer and manufacturer confidence and weighed on investor sentiment. As a result, central banks became more hawkish, raising interest rates in order to try and control inflation, taking the wind out of both equity and fixed income markets. The Brent crude oil rally continued throughout the quarter and produced a return of 7% because of the supply chain disruption fears over the Russian-Ukraine war. Persistent inflation concerns supported investment inflows into gold, but monetary tightening and a surging dollar were likely major drivers of outflows. These pressures increased at the tail end of the quarter as central banks adopted more aggressive interest rate hikes and as fears grew over potential recession, contributing to gold posting a negative return of -6.9%. Whilst the UK equity performance was down 5%, the UK performed ahead of other regional markets due to defensive characteristics and the strength of the energy sector. In addition, large cap companies had strong relative performance, as did defensive sectors like telecoms and healthcare. US equities had the most negative return of developed equity markets, returning -16.6%, the most notable declines in media, entertainment and auto sectors as a result of changes in consumer spending habits. European equities witnessed steep declines, returning -10.4% since the end of March, as concerns spread over potential gas shortages. The EU's reliance on Russia's energy supply and restrictions imposed on importing resources from Russia result in a sharp increase in fuel prices for both households and manufacturers. This also prevents a worrying outlook for the European economy. Emerging market equities and Asia-Pacific ex-Japan equities were also hit by risk aversion and dropped by 7.3% and 9.3% respectively, whilst Japanese equities were less affected and lost only 3.7%. Within fixed income, both gilts and index-linked gilt performed poorly because of more hawkish rhetoric from the Bank of England, returning -14.2% and -19.8% respectively. UK corporate bonds also performed poorly, returning -16.9%. Now let's take a deeper dive into the equity market performance. Higher inflation expectations, soaring interest rates, and a worldwide economic slowdown led to an exceptionally difficult quarter for investors. Global equities were down 14.8% over the quarter as investors moved to price in further interest rate rises and increased risk of recession. Investor focus was trained on inflation and the policy response from central banks for much of the period. UK equities outperformed many of their global counterparts. Large cap UK companies held up relatively well as traditionally defensive areas of the market outperformed, including the telecoms, healthcare and consumer staples sectors. In contrast, fears around the impact of high inflation, 2 consecutive 0.25 interest rate increases, and the cost of living crisis weighed heavy on the stock valuation of small and mid-cap consumer-focused companies. Emerging market equities saw a decline in returns during Q2, with the strength of the US dollar being a key headwind. Across the quarter, the US dollar strengthened as a result of the Federal Reserve's tighter monetary policy, making dollar-denominated debt more expensive to service and increasing the likelihood of default in countries which have a high US dollar-denominated debt exposure. This graph illustrates the yields on over 5-year index-linked gilts and over 15-year gilts. Persistently high inflation remained the main concern in Q2, encouraging the Bank of England to take further measures against it by increasing the base rate by a combined 50 basis points. They did this with 2 consecutive 25 basis point hikes to 1.25%. CPI inflation was measured at 9.4% in June and forecast to reach just over 13% in the fourth quarter of 2022. Gilts have continued to sell off sharply, with yields markedly higher amid still elevated inflation data, hawkish central banks and rising interest rates. Gilts rallied into the quarter end amid rising growth concerns, slightly curtailing the negative returns. Overall, real and nominal gilts performed poorly, returning minus 19.8% and minus 14.2% respectively. Sterling corporate bonds also negatively impacted by the high inflation environment and weakened economic outlook, returning minus 16.9% over the quarter. We'll now provide a brief overview of the UK economy. UK GDP is estimated to have increased by 0.8% in quarter one. The largest contributor to the increase was transport and storage, driven by positive contributions in warehousing and postal activities. There were also positive contributions from information and communication, driven by rises in computer programming. Human health and social work activities fell by 2.3% in quarter one, reflecting a large fall in COVID-19 detection activities. This follows a marked increase in output for human health and social work activities at the end of quarter 4 of 2021 because of the COVID-19 vaccination booster campaign. UK GDP is estimated to have fallen by 0.1% over quarter 2 based on the first estimate. In output terms, services fell by 0.4% in quarter 2, with the largest negative contribution from human health and social work activities, reflecting a reduction in coronavirus-related activities such as GP visits and lateral flow test orders. There were particularly positive contributions from consumer-facing services. Travel agents and tour operators did particularly well as COVID-19 restrictions eased on the tourism industry, and many planned their first holidays abroad for nearly 2 years. Other leisure activities such as accommodation and food services, arts, entertainment and recreation activities also made a positive contribution. The next slide shows longer-term UK economic growth in greater detail. GDP is estimated to have increased by 0.4% in May, but decreased by 0.6% in June. However, it must be considered that the Platinum Jubilee and the move of the May bank holiday led to an additional working day in May and 2 fewer working days in June. GDP was up 1.9% in the 12 months to June and is now at its pandemic levels by 0.9%. The graph also shows the output for consumer-facing services and other services. As we can see, at the start of the pandemic, consumer-facing services declined significantly but have recovered somewhat since then and now sit around 4.5% below pre-COVID level. Output in consumer-facing services remained flat in June, following a fall of 0.3% in May. The largest negative contributions to consumer services output over the quarter resulted from a 5.4% fall in human health and social work activities, reflecting a large reduction in coronavirus activities such as NHS test and trace and the COVID-19 vaccination programme, and lateral flow test orders over the second quarter. Production output rose by 0.5% in quarter 2, a slowdown compared to the previous quarter when it increased by 1.3%. Production output remains 1.2% below pre-pandemic levels. The quarterly rise in production output was driven by a rise in electricity, gas, steam and air conditioning supply, resulting from growth in the manufacture of gas as well as electric power generation, transmission and distribution. The next slide analyses the change in unemployment rate in the UK. Since the start of the pandemic, the UK has seen unemployment levels increase, despite the government furlough scheme helping to offset the impact of COVID-19. However, over the past year or so, the unemployment and employment rate have shown signs of recovery. From March to May 2022, the unemployment rate has seen little change and remains flat at 3.8%. The number of job vacancies in April to June 2022 rose to around 1.3 million. However, the rate of growth in vacancies continued to slow down. Total wages also improved in March to May 2022, rising by 6.2% and by 4.3% when excluding bonuses. In real terms, adjusted for inflation, total pay fell by 0.9% and regular pay, excluding bonuses, fell by 2.8%. We should note the Office for National Statistics cautioned that previous month numbers were influenced by temporary factors linked to the pandemic, but are slowly working their way out of the latest unemployment forecasts. We will now discuss the outlook over the short and medium term. This slide shows the International Monetary Fund's growth forecast for the year ahead. The IMF has revised downwards the global economic growth for 2022 and 2023 since the last review in April. Several shocks have hit a world economy already weakened by the pandemic, higher than expected inflation worldwide, especially in the United States and major European economies, triggering tighter financial conditions, a worse than anticipated slowdown in China, reflecting COVID-19 outbreaks and lockdowns, and further negative spillovers from the war in Ukraine. It projects the global growth to slow down from an estimated 6.1% in 2021 to 3.2% in 2022 and 2.9% in 2023. This is 1.2% and 0.9% lower for 2022 and 2023 than projected in January. Moving on to the next slide, inflation remained a key risk factor and one of the main headaches for central banks over Q2. As already discussed, at the end of June, CPI reached a high of 9.4%, the highest recorded annual inflation rate in 30 years. As a result, markets are now expecting more aggressive central bank policy to curb inflation, with investors pricing the Bank of England base rate to as high as 3% by March 2023. Tighter monetary policy will inevitably have real economic costs, but delay will only exacerbate them. Targeted fiscal support help to cushion the impact, but with government budgets being stretched by the pandemic already, such policies will need to be offset by increased taxes or lower government spending. Policies to address specific impacts on energy and food prices should focus on those most affected without distorting prices. And as the pandemic continues, vaccination rates must rise to guard against future variants. In terms of financial markets, investors should acknowledge short-term headwinds, such as central banks ramping up interest rates to curb inflation, as well as the Russian and Ukraine war, which may provide difficulties in certain areas, such as energy prices and supply chains going forward. We are relatively neutral on developed equities. The short to medium term headwinds should not be overlooked, however. Developed market equities can provide a much needed hedge against inflation. Stock selection is key, given stagflation and geopolitical risks, favouring companies with more resilient pricing power and strong supply chains. We're also neutral on emerging market equities. Emerging market economies have the potential to benefit from a post-COVID-19 economic recovery. However, there are significant risks, including the outcome of the Russian invasion of Ukraine and China's draconian lockdown measures. Consideration must be made in terms of regional selection, whereby regions that are less exposed to the war and inflationary pressures, particularly due to rises in commodity prices, are better positioned for the future. With regards to UK government bonds, despite a rise in yields over the quarter, these remain low. However, UK gilts continue to offer reasonable matching characteristics for pension schemes and should continue to be considered for de-risking plans. We have a positive outlook on corporate bonds, despite headwinds in the form of inflation, interest rates, economic uncertainty, and general credit quality going forward. Short-dated credit investments remain compelling and have the potential for outperformance relative to their government counterparts, as well as providing a useful source of income for pension schemes. Private markets remain an attractive alternative to traditional asset classes. Private credit can provide an effective hedge against inflation, and it offers a senior position in the capital structure, as well as high levels of income with low volatility. However, liquidity risk remains an important consideration for investors needing to meet cash flow requirements. Thank you for listening to Quantum Advisory's quarterly investment podcast. We hope this edition has been informative and provided you with an adequate update on the current economic climate. If you'd like to discuss any of the topics raised in more detail, then please get in touch with your Quantum contact. Once again, thank you and goodbye. Until next time.